Hi, I want to thank you all for joining us today, and I want to introduce you to someone I consider a real expert in the field of investing, and it's Katie Sulkowski. She's a CPA. She worked in forensic accounting and also mergers and acquisitions, and she currently works at one of the top investment firms in the country. And Katie, what led to this, I was watching a thing on CNBC today, and they were talking about where the ultra wealthy are moving their money right now. And they're talking about family offices. And these are families that have made money generation after generation. And by a long shot, the ultra wealthy are moving into equities or stocks right now. So one of the concerns that the average person has, of course, is all the risk involved in stocks. So my question to you is, how can you invest in stocks and reduce or keep the risk down?
Sure. So if you invested in the S&P 500 over the last 30 years, so you invested $1 million to keep numbers very round here, that would be $21 million today. That's investing in 500 companies. If you think about it, your 31st stock pick technically is a worse pick than your 30th. So the more diversified you get, the lower quality businesses you're really investing in. So I believe it's very important to have a very concentrated, high quality portfolio. An investment strategy that I'm aware of, over the same 30-year period, $1 million would be worth over $70 million today. And that's through protecting on the downside, through keeping quality high, and your investment guardrails extremely difficult to surpass. So you're only investing in your best ideas and not diluting the earnings growth or the quality of the companies you're investing in.
So that's not how mutual funds manage it. I mean, I see most mutual funds have 150, 200 different stocks.
Sure. And it becomes more difficult to deliver exceptional returns, I believe, with the more diversified you get. So concentration used to be considered, the more concentrated, the more risky. But there's been several studies beginning back in the 1960s that after 15 stocks, it's actually diversification. So it really depends on your preference and your risk tolerance and also your time horizon. But truly believe high quality stocks and equities, if you have a 5 to 7 year window, it's a very strong place to be, just looking at history in terms of a proof point.
Well, let's talk about the types of stocks you use, because I think that also is a way of reducing risk. So how does your company go about selecting those stocks?
Sure. So high quality to us is twofold. One, the company has to have a very proven track record of success. So their financial statements. There has to be proof of abundant cash flow and profitability and a reinvestment of that cash flow for growth. So we want to see hard facts in their historical financials that they are superior in terms of their stability financially. And also we want to see a very wide moat or a strong competitive advantage, one that's not dissipating. If anything, it's accelerating over the next 5 to 7 years. And many times that's through what we refer to as secular tailwinds. So an example of this would be payments. It used to be that everything was paid for in cash. Today, you and I are paying with a debit or credit card. And 10 years from now, I'm fairly certain most payments will be digital. So this secular trend from cash to credit to digital, we don't think is reversing. The genie's not going back in the bottle. So most of our investments are also benefiting from kind of that push or that tailwind of a secular growth story.
Yeah, so the other thing that I notice is they're not moving a lot of money over to real estate. Do you have an idea why that's happening?
Yeah, twofold. Real estate tends to be very boom and bust. It tends to move in cycles. Our current environment right now is certainly a boom, and that more than likely, if history repeats itself, will be followed by a bust. We like to invest in companies that are steadily compounding, steadily growing, regardless of the market environment or the cycle they're in. And also real estate companies, it takes a lot of money to buy property. So they're typically debt latent. They have a lot of debt on their balance sheet. We prefer companies to be in a net cash position, as I'm sure you can imagine why. And for those reasons, we tend to avoid investment in the real estate sector.
Yeah, so we actually have a chart that shows, and we'll put it up, shows that real estate goes through 9.5 years up and 9.5 years down, and we probably peaked about 2 years ago.
Yeah.
So we're also in agreement with your company's philosophy on it. And then the last area, and I'll talk about it because this isn't your area, is they're moving into municipal bonds. Not as much as equities, and the reason is they see taxes going up, which I'm sure you all are in agreement on that area. But you also manage your equities so it's a low tax portfolio. How do you do that?
Sure. So we invest for the long term. Our philosophy is if you find a great business and you trust that it can grow its earnings, its income over the next 5 to 7 years, you have to give that stock the time horizon so that the stock price can catch up with that earnings growth. So we really apply patience. We've only held 125 companies in our portfolio over the last 32 years. So we know these companies inside and out. We are very confident relatively in the growth story, and we give those companies time for the stock to catch up with the earnings growth. So we're very low turnover. We're not trading in and out of stocks or trying to time the market. Nobody knows what the stock market's going to do day to day, but we're confident that over the long term, the weighing machine or the fundamentals and the really strong businesses in terms of earnings and growth are ultimately rewarded.
So that really concludes our program today, and I want to thank Katie for joining us and being our resident expert. And if you have any questions about anything we talked about or concerns, or you know someone who's having a tough time figuring out how to invest in this volatile time, please give us a call and we'd be glad to help you on those areas.
Thanks, Doug.
Thanks.